What is one of the biggest, most memorable takeaways so far from one of the meetings that you sat through and listened to? Let's say you're sitting in a meeting and you're like, oh my gosh, I've never heard of this before, and this is incredible. Or you say, oh my gosh, I heard of this. I didn't realize it applies like this. What I'm looking more for is like what's sticking with you? What is the thing where you're like, man, so I need to do this, or man, I really wonder like the other day you said, why are you recommending an LLC versus an S corporation versus Z corp?
Yeah.
Right. So that would be kind of the element there, but I'm not asking necessarily that particular question. I'm thinking, okay, so if I'm Ian and if I get off the Zoom meeting and I was just exposed to this pretty high level discussion,
Mhm.
a pretty detailed discussion, what are the things that you're taking away from that? And maybe one was like, dang, I didn't realize I could make $1 million in construction.
Yeah,
Or
yeah.
dang, I didn't realize that, other CPAs have challenge with their own tax bill, right? Whatever that might turn into or whatever that might be as you're looking at these, what are those types of things or thoughts that are going through your head?
One is like just these people are running as an LLC and they could be better off doing an S Corp or C Corp. And like it's just a lot of businesses. Like I've noticed like with many people, they're they're gonna benefit from transitioning into this instead of doing this. And it's honestly like kind of insane just how much money they could be like saving or how much it could go towards the business instead of towards other things.
Okay. So, and again, too, like part of this meeting is also me kind of just checking in with you to see how things are going and like what do you like about what's happening? What do you want to see more of? Is there anything that you're going through that you're challenged with and you don't understand? Or are there questions that you want to bring up that we kind of talk about, right? This is your mentor happy hour, if you will. Understanding that what you're doing for me now, it seems like you're enjoying it. It seems like you want to continue it. Is that a fair
Mm.
assumption?
Yes, it is.
Yeah. Okay, cool. So give me one of the best things that you enjoy doing.
I just enjoyed honestly just observing everything from the meeting. I'm not observing just like I said in the other meeting we just had right now, but I'm not only observing your tactics, I'm observing like just what these people are doing and living their life, their lifestyle and since like that. I like seeing just how do these people manage their money. A lot of them aren't being flashy with their money. A lot of them have so many investments in like stocks and just like real estate.
What are some of the questions that come up as you're watching these things?
I see all the people that like make this type of like mistake in terms of taxes, but a lot of them are tracking your expenses because I've seen that from the first meeting I did all the way till recently. But some of the questions, I guess, how does someone know if they should transition their LLC from a S corp? I see that those three things a lot: LLC, S corp, C corp a lot, and I'm a little confused on it.
So when you first go into business, I have a rule of thumb, and or I have the first rule of business is make it easy for your clients to pay you. And that means that's what you should be focusing on. Okay.
Mhm.
Most of the time, business owners kind of sit there and think, oh, well, should I go and get an LLC or should I go get an S Corp or, should I do this or should I do that? And it's like, okay, have you made any sales yet? Well, no, I'm just wondering. Da, da, da. Okay, well, go make sales first, right? Go create a business first because until you do that, you don't have a business. So you don't have to worry about whether or not you have an LLC or an S Corp or a C Corp, right? When somebody goes into the business and now they're in business and now they say, oh, yeah, I got an LLC. Okay, cool. Now you got the LLC. So the beautiful thing about an LLC is an LLC you can make an election with the IRS that allows that LLC to be taxed 4 different ways. It starts out as the LLC doesn't exist except for legal protection purposes. So the IRS is not even going to recognize the LLC exists, right? We call that a single member LLC. Single member LLCs, are disregarded for tax purposes and you file that business activity on your personal return Schedule C. Okay. The benefit of having the Schedule C is that it doesn't require crazy levels of bank account activity. It doesn't require crazy annual compliance. It doesn't require any of that. One of the other big benefits that I recently discovered is that if a business owner pays their children out of a Schedule C business, then as long as that child is 16 years or less or younger, the payroll being paid to that child is not subject to payroll tax. Payroll tax is 15.5%. And so if you decide to pay, or if somebody decides to pay their child, ten or $15,000, $15,000, if you do it inside of an S corporation or a C corporation, you pay payroll tax on it. Rounded, let's say 20 grand for mental math purposes, 15% on 20 grand. Well, that's $3,500 worth of tax. So if you do that through a Schedule C, you don't have to pay that $3,500 in tax on the Schedule C. Now, again, if you do an S corp, you have to pay that. Going back to the original question, how do you determine what entity? Right. So one of the other benefits of having a Schedule C is that you don't have another tax form to file. Right. You don't have to file an LLC tax return. You don't have to file an S corp tax return. You don't have to file a C corp return. One of the other benefits of the Schedule C is you don't have to file a balance sheet with the IRS. Not a lot of people understand what a balance sheet is, but a balance sheet talks about the structure of the business, right? The profit and loss statement talks about the cash flow of the business. The balance sheet talks about the intrinsic structure of the business, right? Think of it this way. Your body is composed of muscle, bone, ligament, all that stuff, right? It's also composed of the blood system. So the muscle structure, the bone structure, the ligaments, the cartilage, all that stuff, that's the balance sheet.
Mm.
Blood, the blood is the cash flow, right? And so when you look at the health of a business, you not only look at the P&L and the income and expense, but you also look at the balance sheet. So it becomes a little bit more complicated to report. So with the Schedule C, you don't have to worry about making sure the balance sheet balances. After all, it is called a balance sheet, right? And it needs to balance. The downside of a Schedule C, though, is that after the net income approaches about $85,000 a year, your net profit is subject to self-employment tax, which is 15.5%. Okay. Um, Now, some would argue that the self-employment tax is really 17.5 or 17.3, which in theory that is correct, but for the most part, it hovers between 15 and 17%. So on a Schedule C, your net profit at the end of the year is all subject to self-employment tax. Okay. So self-employment tax flows through, but then that same net profit gets taxed
Mm.
at income tax. So it's being taxed twice. So it's being taxed at the income tax level and then it's being taxed at the self-employment tax level. Self-employment tax is fixed. Self-employment tax is assessed on the Social Security wage base of whatever is declared for that year. Currently, that's $168,400, $164,400, which means your net income on a Schedule C will be taxed up to $165,000, will be taxed at 17%. Then it'll be taxed again at the income tax level. Okay. So that can stack up a tax bracket quite a bit. If let's assume you are now an S corporation,
Mm.
exact same mechanics. Okay. Same gross revenue. Now you're, under the Schedule C theory, we were talking about $168,000 wage base, all that stuff. On the S corp level, the net profit is no longer subject to self-employment tax. Okay. So that's the big difference. And a lot of people go and they say, okay, so we're going to have our LLC now taxed as an S corporation because we don't want to pay on $168,000 times 17%. That's like $22,000 in self-employment tax, right? That's a
Mm.
lot of money. So they say, well, cool, I'm going to go create an S corporation so that I don't have to pay the $22,000 in self employment tax. Well, the IRS knows this is an issue, which is why they look at S corporations to make sure that there's payroll being paid out of the company. And so at a certain point in time, you as the owner of the company are going to need to think, okay, so at what point does it make sense for me to start an S corporation? When you look at converting an LLC to an S corporation, you want to first look at what how much would your wage be if you paid yourself a payroll regardless of the rules. Okay. Are you paying yourself 5 grand a month? You paying yourself 8,000 a month, 10,000 a month? And a lot of people don't know that.
Another question, that's another question I had, just how does even someone figure out how much to pay themselves? And
AI has made it a lot easier. I'll tell you that.
yeah, yeah.
Um, but here's the other thing too. There are so many job offers out there right now that somebody, if someone says, okay, so Jeremy, you're the owner of the company, but what do you do for the company? Well, I do sales, new client relationships. I do office management. I do tax strategy. I'm the tax preparer. Okay, what do you mostly do? Well, okay, well, when you talk to people, what do you say? Well, I'd say I'm a tax advisor, right? So that's my job title. So I go out and I look and I say, what kind of jobs are paying? What are jobs offering from a compensation perspective for the job title of tax advisor? So you go out there right now and you realize that most people with an EA with 5, 7, 10 years of experience, a lot of them are getting paid $100,000 a year. Okay, that's how much I'm going to pay myself. Magically, that's actually how much I pay myself currently out of my business. If I'm running a Schedule C and my net profit is more than $100,000, then I'm paying excess amounts of self-employment tax because in reality, I should be only paying myself 100 grand.
Mhm.
So the S corporation allows me to do that. So when with having the S corp in place, I run a payroll for myself for $100,000. I pay self-employment tax, the equivalent of self-employment tax, which is called payroll tax, on that $100,000. It's calculated the same as self-employment tax is. And but everything over that is not subject to self-employment tax. So, just the other day I had that Zoom meeting with that lady. Her LLC is doing $800,000 in net profit every year, right?
Yeah.
Well, it became blatantly obvious that her tax preparer hasn't recommended the S corporation yet. But when you looked at the facts and circumstances, she's paying self-employment tax on $800,000 worth of wages, is basically what it is. And so when you calculate 17% on the first $168,000 plus 2.9% everything over that, and then everything over 350 grand, there's another 0.9% for Medicare tax. You add all that up, and we found out she's paying what, 50 or 60 grand in self-employment tax for no reason because nobody is going to pay they're not paying themselves an $800,000 wage. When you consider taking an LLC to an S corporation, the wage factor is the biggest determining factor. If your net profit on the LLC level is in excess of what you would normally pay yourself on the wage level, then it makes sense to move over to an S corporation to save the self-employment tax on everything above that.
A lot of these people that are making this much amount of money, they're paying themselves this amount. And I heard something about deductions, or not. Yeah, I think it's deductions. It's how they would pay themselves from their business also,
Give me an example or elaborate on it.
or not just distributions. I think it is.
Oh yeah. If I go from an LLC, let's say my LLC is making 200 grand a year and I would normally pay myself $80,000 wage, right? There's an
Mhm.
extra 120,000 there, right?
Yeah.
So now I go over to the S corporation and I pay myself $80,000 out of the S corporation. I'm left with $120,000 quote unquote remainder. I would let the business pay me, but not in the form of a wage. Those are called distributions. Distributions are money that you pull out of a business in the form of a return on your investment, if you will. Now, I have to be careful with that
Uh-huh.
because it gets the rules get a little hairy. But here's what it is: a distribution is a payment that's made out of a company that you own to you personally out of the equity that you own in the company. That's what it boils down to. Now, the equity is equal to tax basis, which is equal to the amount of money that you have put in to the company to start it and or to fund it again, and whatever net profit is at the end of the day on the S corp. So if the S corporation has a net profit of, let's say, $250,000, that $250,000
Mhm.
is going to flow through to you personally on the form K1. And you're going to have to pay tax on that for income tax purposes. That K1 is not subject to self-employment tax. Okay. Let's say that you already paid yourself a wage, but now you have $250,000 in equity in the S corporation and you want to access that equity. The way that you access that equity is through a distribution.
It would come, like, through a different way. Like, would it be this money they're taking out, or would it be like a bonus? Or how would they get that money?
Well, so the key is that as a business owner, you want to build up your equity in the business. And so in order to build up the equity in that business, you have to build up the net income of that business. The more net income, the more equity you have. And when you tap into that equity, that's where you get paid. And that payment, by the way, is tax free. Okay. Now, in order to get the equity, you first have to have the net income, which generates a tax bill. So by having the net income, that net income generates the tax. After you pay the tax, that gets converted to equity. Okay. So now you have equity out of the business. And now, as an S corporation, you can reach into your business checking account and make the transfer of cash out of the business checking into your personal checking. And that's the
Mm.
distribution out of equity.
Will, like, the IRS try to, like, look at anything like that? Like, how much distribution you're having, or
Yes, the IRS does consider how much money you're pulling out from equity. So it goes back to the original discussion about the LLCs, right? When you have an LLC or when you have that S corp, the Schedule C, that net income is subject to self-employment tax, right? So to avoid the self-employment tax on such a high level of dollar, they want people, taxpayers, convert to an S corporation because the profit of an S corporation is not subject to self-employment tax. Now, as we covered earlier, now what they do is they say, okay, so you're paying yourself a wage, right? And you're the same wage that you would normally pay yourself, regardless of whether you're an LLC, S Corp, C Corp, Schedule C, it doesn't matter. So let's say you pay yourself a wage. Well, let's say there's some greedy folks out there and they're paying themselves, a $25,000 a year wage. And realistically, their net income is $500,000, right? Their business is a multi-million dollar business. The net profit's 500 grand. They have a lot of people working for them. And all of the people that are working for them are all making well over $25,000 a year, right? Well, the IRS is good. But then, so this person drops their wages because they don't want to pay self-employment tax. But then they're pulling $500,000 out of their equity account, right? Because it's not subject to self-employment tax. So they have $25,000 in wages and they have $500,000 in distributions out of equity. IRS is going to look at that and they're going to say, hey, wait a minute. You're not paying yourself a reasonable amount here. Your wages need to increase. You don't have everyone on your team is making way more than you are making currently, which means the way that you're setting this up, you're doing it specifically to avoid self-employment tax. So if that's the case, we, the IRS, are going to come in here and reclassify all of the payments that you've pulled out of the S corporation as wages to yourself, and now they are subject to payroll tax. We call that a reasonable compensation argument, right? Is your compensation reasonable? And so you may have heard me say it in the meetings. I usually stick to if your profit is $500,000 and you're paying yourself $100,000 in wages, feel free to take $300,000 out of the equity. But if you're taking $500,000 out of the equity and you're paying yourself 50 or 60 or $70,000 in wages, now you have a very obscured, 1 to 4 or 5 to 1 or a 6 to 1 ratio of distributions versus wages. IRS, that's a big red flag for the IRS, and they will come look at you and they will come and adjust that for sure.
Yeah, that's what I had a question about. Like, how's that not a like a loophole? Like, people could just pay themselves this much and pull out this much, and it's not subject to tax. Yeah.
I mean, there's people that abuse that all the time, and the IRS is looking at them for sure. So, I try to stick to a 3 to 1, 4 to 1 ratio at any given moment in time, or whatever reasonable compensation is, right? And that might be, a 1 to 1 ratio. So they might be paying themselves 80,000 a year in wages and 80,000 a year in distributions, you know.
You recommend like a many different deduction ways to, or many different deduction strategies to these people. Will the IRS try to like fight you in a sense, like on how much money you're not giving them? And
They will. To the extent that they think that what I'm doing is illegal or unreasonable. Absolutely. And that's what the IRS audit process is all about, right? So after you file your tax returns, the IRS has the ability to come audit you. And the statute of limitations, by the way, for them to come in and look at your stuff is 3 years from the day that you file a tax return. Okay. So if you're filing your return February 17th, 2025 or 2026 coming up, they will have till April 15th, 2029 to pull your tax return to look at what you did. So they have 3 years, right? They
like,
have 3 years to come in, look at what you did, and then change the tax liability associated with that if they decide to change it. We call that the statute of limitations. So the IRS is going to come in, they're going to look at your tax return. They're probably going to look at the year after and the year before. So if they're coming in to look at you right now, it's December 5th, 2025. If you get selected for an audit, chances are they're looking at your 2024 tax return or your 2023 tax return. So we're already 2 years into that process for them to be able to change it. Now, they can make it a 6 year process if they find out that you substantially understated your income. Then they open up a 6 year statute and they can go back and change your tax returns for up to 6 years. If they find that you fraudulently filed returns, they can open up any year they want. There is no statute of limitations. They can go back to 1979 if they'd like.
does that happen quite often?
The fraud statute doesn't happen quite often, but the 6 year statute, I've seen it happen more often than I'd like to see it. They have to get a judge to approve the 6 year, opening up the 6 year statute. And I should really kind of like fix that statement because I don't see that a lot. I've only seen it happen one time. And that was because the person that I was representing back then, which was 2015,
Mhm.
I mean, he was being pretty reckless with his financials. I wasn't representing him during that time, or I wasn't doing his taxes and doing his accounting and stuff. I picked it up after the fact, after the IRS has already looked at him. And I was like, dude, I mean, you can't deduct a custom closet as office supply. He's spending $25,000 on a custom closet for his master bedroom, and he was deducting it as an office supply. You know what I mean? Like, you just can't do that. That's not right.
Yeah, I guess that goes with another question. Just these people are like, you recommend tracking your expenses a lot, but how do you determine what's a deduction and everything like that? I know you say if it has to do with your business, then like say you go out to dinner or something and you're talking about business, but like doesn't it get to an extent and just do people try to abuse it?
Well, people try to abuse it all the time, which is why, especially like when people go out to dinner, you can only deduct 50% of it. And you can't deduct alcohol. Alcohol is a non deductible expense. So if you go out and let's say you go out to a nightclub and you're entertaining a client and a bottle service for that table was 5 grand. Sorry, it's all alcohol. You can't deduct any of it. So you can't deduct it at client relations. You can't deduct it at meals. You can't deduct it for any of that. Like, because it's all alcohol. The IRS specifically says you cannot deduct alcohol. So a lot of people try to abuse that though, anyways. And, they'll go out to dinner and they'll rack up a $600 bill, not realize that 2 bottles of wine is $350 of that bill. And then they think they go and deduct $600 thinking that it's deductible when really only $250 of the bill is deductible, assuming they talked about business. So there's a lot of abuse there. And how do you really determine whether or not you have other deductions or not? I think that you use your best judgment as to whether or not the thing that you are spending the money on is for maintaining your business or for growing your business. So, when I go to Costco, for example, and I'm buying paper for my printer over here behind me, that's a deductible business expense. But if I go to Costco on the same trip and I'm buying, 5.5 pounds of cowboy cut, you know, prime rib, bone in prime rib, like that's a $75, purchase. Like that's not deductible, obviously.
Yeah.
Unless I'm cooking it for a client, in which case, out of the two steaks that I buy, only one's deductible.
When you are tracking those, does it have to be that technical? Like how much will it be? And like straight to the dollar, kind of?
Well, some things are more obvious than others. So I'm buying a computer. I use that computer every day for work. That's an obvious work expense. That's not a, hey, I went to dinner with a client of mine and we had a great time and we talked about business. Some expenses are more obvious than others. Take those and understand what those are. Now, because of the fact that there was so much abuse in the last 2 decades, in the last 20 years, there was so much abuse around meals deductions. There was so much abuse around travel. The IRS finds those things very, very, very heavily scrutinized. And so the IRS is going to continue to scrutinize those because they continue to see people taking their entire family to Hawaii on what they call a board meeting, when realistically all they're doing is going to Hawaii to swim with the dolphins and hang out on a family vacation. Yeah, and then they put their kids on payroll, and then their wife or husband's on payroll, and then they all take this business trip to Hawaii as a employee getaway or an employee retreat or something like that, but none of the other employees are invited. So it's like, okay, so that's a family vacation and you're trying to deduct it as a business trip. Like, come on. And then you think because you can deduct it, you don't have to pay tax on it. Now all of a sudden your stay at the Hampton Inn turns into a stay at the Ritz Carlton. You know what I mean? Because you're like, oh, it's a tax deduction anyways. I don't have to pay tax on it. So there's people that do that all the time. And now,
Mhm.
mind you, Jeff Bezos works 17 hours a day and he's not staying at the Hampton Inn. Homeboy's staying in hotel rooms and they're $4,000 or $5,000 a night, right? And those are deductible because he's working on his business while he's in those hotels. He's having business meetings. People are flying to come see him in those hotel meetings to have to proliferate his business. So do expensive trips happen? Yes, they do. But an auditor is not going to come look at Jeff Bezos and say you spent $65,000 on 1 week at Ritz Carlton. That's not a deductible expense. They're going to look at that and they're going to be like, yeah, show me your calendar and show me all the people that came into your suite while you met with them just to confirm that that was business. Right. I mean, there's certain things that auditors sit back and say, like, yeah, clearly that's a business deduction. You know what I mean? Um, the wobblers are mostly meals, their travel, some office supplies, especially lately because Amazon has become so dominant in the delivery space that it has become more than just an office depot for businesses where businesses go on Amazon and they buy all their stuff on Amazon, right? Because it's business owners don't have time to go shopping and they don't have time to do this and do that for their business supplies.
Yeah.
Like I buy my printer ink off of Amazon, I buy my paper reams on Amazon, I buy all the stuff that's on my desk from Amazon, all that stuff. Well, guess what else I buy from Amazon? I'm buying, cameras. I'm buying
Yeah.
hard drives. I'm buying, you know, my Meta glasses. I'm buying earphones. I'm buying a lot of stuff that are not necessarily business expenses. And so, people don't want to go through and comb through all of their Amazon purchases. Just say, oh, this is deductible. This isn't. This is deductible. This isn't. They just set a QuickBook rule, and then everything that comes in from Amazon is an office supply. So IRS comes in, says, "Hey, give me your purchase history on Amazon," and they're like, "Dude, like 85% of these things, you're buying plates and cups and espresso machines and coffee mugs and you know all these exercise equipment and all this other stuff has nothing to do with your business. So you're not. We're gonna totally and completely disallow all this crap that you're buying that's not related to business that you already deduct." I started a podcast. I bought 3 video cameras. All those cameras have been used for podcast recordings, and all of them are being treated as deductions for that reason. Am I using any of them to go film myself snowboarding? I would love to, but no, I'm not. It's a $500 camera. I'm not going to take it snowboarding and risk the chance of it getting broke or something like that. So,
Mhm.
am I taking pictures of my family and my kids for, family photos or something like that? I haven't yet. I might. I don't know. If I take a family picture and put it on a Christmas card and mail it out, does that make it a personal expense? No, it doesn't, because now my cameras are primarily being used for my podcast, for my Zoom meetings, for all these different things that we got going on. So a business deduction, some are more obvious than others, but that's why I say capture all your expenses, because when people look at their expenses from the mindset of, I know these are obvious business deductions, they filter out what they would consider not a business deduction, and they frequently miss things that are legitimate business expenses. And so where I say is that you can always delete the expense from your P&L. It's harder to add to the P&L than it is to delete from, right? Because you don't know what's missing if you don't know what's missing. So capture everything and then filter out all the things that are not deductible, rather than filter everything that's you think is not deductible and then leave the rest. So reverse engineer it, capture everything and then remove the non-deductibles versus only keep the deductibles. Your field of view is so much more narrow when you focus on what's deductible rather than focusing on everything and then sorting through it after that.
Say if you did have something that you're primarily using for the business and maybe you sometimes use it for yourself or something personal, it could still, it's just whatever it's primarily being used for.
Primarily being used for. Yeah, for sure. 100%. I use my cell phone to talk to clients more than I use my cell phone to talk to my wife or my son. That makes my cell phone deductible. That's normal.
Will the IRS think that's like fishy in a way? Or, well, it's like a valid reason.
Well, I mean, what they're going to look at is they're going to say, okay, so let's take a look at, you're paying for your cell phone, no problem. Are you paying for your wife and your son and your other cell phone and your other iPad and all these other things? And are you deducting those too because you don't want to separate out or itemize your cell phone versus theirs? Right? You see what I mean? And a
Yeah.
lot of people just kind of like throw the whole AT&T bill in the P&L, and they're like, yeah, well, whatever. It's not that big of an expense anyway. IRS is never going to look at it. They're never going to catch it. They're never going to find it, whatever. Well, yeah, they can and they might. And when they do, and they're going to not only catch that, but they're going to catch that perspective on all the stuff that you did. And then they might even use that to open up the 6-year statute because you materially understated your income.
And
So,
when they do get that statue, they get to look at everything.
well,
Correct.
now you're looking at 6 years as opposed to 3, right? Now you're being challenged about 6 years instead of 3 years. Nobody wants to have their challenge double.
Another question. This How does your kids on payroll help your business?
My son Aaron is on payroll, and he helps my business in multiple ways. Not only does he take out the trash, not only does he shred my sensitive paperwork using a shredder, not only is he helping me file documents and things like that, for hard copies. Like power of attorneys are a great example. When I get a client to give me a power of attorney with the IRS, I have to have it on file for a minimum of 6 years, right? So he makes sure that after I sign it, paper sign it, it's in this filing system, right? Not only does he do all that, but um, he helps me identify what's trending on social media. Sometimes he actually helps film these podcasts. So if I'm like, So I have a series coming up where I'm gonna be giving tax advice while I barbecue, right? So, well, that's outside and next to the barbecue, and so somebody's got to handle the camera. He'll be my cameraman, and so there's a lot of different things that he does to help support my business. And I think one of the things that he hasn't done yet, which I'm not sure I'm comfortable with, but he has been a co-host with me or a guest on the show on a podcast that I had that actually what turned out to be a very, very successful podcast. And I had a lot of feedback about how great that was from my clients who saw that, specifically mentioning the fact that when I interview my 11-year-old son, his perspective of wealth and finance and how it relates to us adults. So I think for people, once they start tallying up, what their kids really help them do in their business, that's when they should consider putting them on payroll.
How you're saying, like, that's how someone would figure out what they're doing for their business, how they pay them out. How would you determine what your kid is doing in a sense? Like, how much would you figure out how much to pay them?
Well, you go on the same theory of if I paid somebody else off the street to come in and do the same things that he's doing, how much would I have to pay them? Right now, minimum wage in California is $16.50. So automatically, he should be making $16.50 no matter what he does. He could be standing in this office holding down this chair in case a strong wind comes through. I need to pay him $16.50 an hour because that's required by law, California law. So there's that standard that you can use, or there's the standard of, okay, so if I hire an executive assistant, which I have an executive assistant, and I pay her, X dollars a month,
Mhm.
and does my son do the equivalent work that she does that would cause him to get paid the same amount? And the answer is sometimes he does, sometimes he doesn't. But now I can use that as a baseline to say he's doing similar valuable work as she is, commensurate on the other side. And even though she's, checking my email, doing day to days, interacting with clients, etc., and that she's bringing value there, my son's also bringing the same value by making sure that my food, while I'm while I'm having a lunch meeting, my food is here. While he's bringing me water, he's taking out the trash, he's shredding, he's organizing my documents, he's helping me with social media trends, he's helping me with identifying stuff online, going viral, and all that stuff. He's helping me stay current with the culture, whatnot. So if I were to go hire a marketing agency, which I have a marketing agency, if I were to go hire a marketing agency, what are they going to charge me to do the same thing? So I pay him the commensurate amount for that. Why does that help me, by the way? That helps me
Yeah.
financially because now, even though he's my son and he's 12 years old, let's say that I'm paying him 3 grand a month, which is what I'm paying him. If I'm paying him $3,000 a month, that means that he's going to make 36,000 bucks a year. Well, when he makes $36,000 a year, suddenly the IRS treats him as an adult and he has to file his own tax return. But that's okay because his tax rate is 10% on that $36,000. So, what's even more amazing is he makes $36,000 a year. Now he's entitled to contribute to a retirement plan for himself. So now he can contribute to a 401k plan up to $23,500. So let's assume that he's a great saver because, quite frankly, dad pays for everything in his life, right? So he doesn't really need all that money to live on. So he goes and takes out of the 36, he goes and takes $23,500 out of his paycheck and he puts it into a 401k plan. Well, now his tax is 36 minus 23.5. We're going to call that 13.5. Okay. So that's $13,500. Well, when we go to file his return, the IRS says he's a single filer and he's entitled to a $15,600 standard deduction. So just by being a citizen of the United States, he's able to claim an exemption amount of up to $15,600 on his tax return. So now he doesn't have to claim that he has zero income. And so now I've paid him 36,000 bucks out of the business account, which when you study out my tax rate, I'm paying tax at 30 plus percent. So I'm getting a deduction of 30 plus percent paying him by paying him $36,000 a year. And so he doesn't pay any tax at all. I save $10,000, $12,000 in tax by paying him. We start stockpiling for his retirement or for his college or whatever else. Because when he's 18, he gets full control and ownership of that money. And then he can go and use that money to buy a college education or buy a house or whatever that is. Right. But then also, it also incentivizes him to be responsible with money because now he sees 3 grand a month going into his account and then being deposited into a 401k. So there's a lot of benefits there for sure.
You know many of these like strategies and what to do, what not to do. But like in your shoes, can you apply everything that you know? Like, is it against the law or anything to apply everything you know so you could pay the absolute minimum?
If I understand your question right, your question would be, Jeremy, you're giving advice to all these people. Can you take that same advice without getting in trouble? The short answer is yes, when it applies to me. Now, let's say, for example, I decide that I'm going to go out and buy, a big truck because, I'm going to haul a bunch of material from one job site to the next. And I'm going to deduct it in my tax business. Well, the IRS is going to look at that and say, you don't have a construction business, and all the material that you're hauling is for a business that you don't own or personal use for your home. So you don't need the truck to take a 179 deduction for the purpose of running a tax business. So suddenly a truck no longer becomes a tax deduction. How does that apply with somebody else? Well, if you're a construction company, you need a truck to haul material back and forth. I'm not a construction company. So I don't get that same deduction that he would get or they would get, so to speak. But at the same time, the construction company, they're not going to go out and buy 3 Sony cameras for $600 a piece or whatever it was, the $900 a piece to start a podcast. They don't need to do that. That's not a reasonable, ordinary, necessary expense for a construction company. So, but it's an ordinary, reasonable expense for somebody like me who is in the business of selling my knowledge and monetizing my knowledge for people. What applies to me, I take advantage of all day long. And there's no reason why I shouldn't, because as long as I'm following the law, then it works out. What's funny is, especially with the child, putting my son on payroll is, um, I recommended that to somebody recently, or I recommended that to somebody earlier this year. I was like, "Oh man, you definitely should put your kids on payroll because like you're selling a kid's toy on Amazon and part of your strategy, I'm sure, is taking pictures of kids and posting reviews and like using your kids to help sell the product." And I started to realize it and I went back to my wife and I was like, "Check this out, blah 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 blah." And she's like, "Why aren't you doing that with our son now?" And I'm like, "Well, shoot, I should be." And then so I started doing it. And so I'm like, "Man, I should take my own advice." And so there are some times
Oh,
where I'm like, "That's a good idea. I should do that." I'm going to be taking my own advice a lot more often because I'm getting a lot more often the opportunity to come up with things. And as I come up with things, I'm thinking, "Wow, well, actually, that'll fit my scenario. So I need to execute on that myself."
is there a limit? Like, say you have 3 kids.
As long as they're all providing constructive value and contribution to the company. That'd be like saying, if right now I have, two, three, 4 people on payroll. Well, why do I have 4 people on payroll? Because I have a lot of work to do, right? If you have 3 people that you need to put on payroll, it just happen to be your kids, understand that your business needs 3 people on payroll. That's part of the thing there. And in the example that I gave where the guy takes pictures of his kids playing with his Amazon product that he sells all the time, not one child is in all the photos. You know what I mean? Frequently, most of the photos are 2 or more kids if they're not all 3 playing with each other. So in that instance, like if I were to go hire somebody to do a photo shoot and have 3 of them in the picture, I'm not going to just pay one, right? I'm going to pay all 3.
And how you were saying your son or Aaron is on Like he's putting his money into a retirement account that's fully like deductible
Absolutely. And it's deductible to anybody else contributing to it.
anywhere. So anything you put in, you were to put in for like long term, would that be there? Like if you were to put, say instead of like a 401, you're go to put that money in a stock, is that the same thing or no?
So the 401k in and of itself is the title of what you're doing. A 401k is like an LLC. An LLC is just a vehicle for something you're trying to accomplish. A 401k is a vehicle for something you're trying to accomplish for retirement specifically. And so 401k has rules that the government has incentivized people to put money into a retirement account so that when they reach a retirement age, they're not dependent on the government for their full retirement, right? They're not stressing the Social Security Administration out. And so the government says, hey, we're going to incentivize people putting money into their retirement accounts so that they don't have to rely on the government when they retire. So part of that incentive package is okay, so I'm going to put my money into a 401k. Well, now what do you do with the money? Well, I want to go and invest it. Okay, well, yeah. So now you can go and invest the money that's inside the 401k. So now once the money's inside 401k, you can open up an account at Charles Schwab or E-Trade or whatever, and then you can buy stocks out of that 401k. And you can invest that money in the name of the 401k. Just like if it was in your name, you would invest in your name and you would have that activity under your name. Well, you have it under your name, but it's a different title of an account labeled the 401k account.
And say if that money is not in the 401k and they invested their own money into a stock and it's been going for a while, does that get taxed? Or how does that get taxed?
It does get taxed. Yeah, and it get taxed. So when you open an account in your individual name and you go and invest in stocks, the stocks are going to go up and down in value, right? But the
Yeah.
name of the game is to buy low, sell high, right? Buy the dips, sell the tips is what I call it. And
Hmm.
so when you're buying and in theory you're going to sell at a higher value than what you bought, that's called a capital gain. If you were to buy something and hold it for a long term, IRS defines long term as longer than a year, then you get a special tax treatment so that you don't want to pull it out and spend it. You get a special tax treatment. So that's what we call long-term capital gains tax. Long-term capital gains tax is 0%, 15%, and then 20%, right? Whereas if you buy and sell all the time and you're taking advantage of, short-term holdings, right? Like day trading, but also like so it's opposite long-term. Long-term if long-term is 12 months or more, short-term is 12 months or less,
Okay.
right? So if you hold something for less than 12 months, it's going to be treated as short-term. Now, not all investments pan out. And so if you buy something and then you end up having to sell it for lower than what you bought it for, that's what we call a capital loss. So IRS says, hey, we understand you took a loss, no problem. We'll let you offset your gains with the losses that you've occurred. And so we're first going to take your short-term gains. We're going to minus your short-term losses from that. We're going to come up with a net short-term gain number. And then we're going to look at your long-term holdings. And we're going to say your long-term gains minus your long-term losses comes up with a net long-term gain or loss, right? And so whatever that gain or loss is, it gets added or subtracted from the short-term gain or loss. So if you have a positive net on the short-term gain or loss of, let's say, $5,000, but then the long-term loss of, let's say, $2,000, you have a short-term gain of 3, right? 3,000. So that's what you're going to be, that long-term loss of 2 offsets your short-term gain of 3.
That's pretty much everything I have right now.